Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, we got a great one for you. We're going to talk about why inflation is definitely not over, why your next big trade could be in the commodity space, and why we may have topped out for the month. We got some really good data that would say that we have. So let's dive into this video.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
All right, Bob. So interesting inflation chart that you have for us here.
Yeah. So, a lot of people think that they killed inflation. And we talked about this last week. It's impossible for inflation to be wiped out if we're growing the money supply by 10% over the next 2 years. And all the raising that they've done has only brought the basically inflation rate down to about 5%. And they can't break down below that because the money supply is going to overwhelm the system. And plus wage inflation, because the demographics are going to stay pretty strong. And so you have these situations that we'll call these waves. And we think we're done with the first wave of inflation. Now, this is just an example of what happened in the 70s. But we're gonna definitely turn up the second wave. These waves tend to then support commodities. Okay, and we're gonna get to that one in a second. And the third wave then totally supports precious metals. So I think we're now going to, and the other thing too, is we talked about this last week too, is that the comps, the comparables from last year are also have gone negative in terms of disinflation. So when you start comparing last year to this year, going forward, you're comparing a really good number against a number not so good, which is going to show a rise in the CPI, Phil. And so this, if this plays out the way I think it is, because I think we're definitely matching what happened after World War II and after in the 1970s. I think we're in for basically starting from 2020. We're in about a 12-year cycle of inflation, then bust, is my view. And then what happens with the stock market and the commodity markets, they diverge tremendously. And we'll be talking about that over the coming weeks. So that's that chart, Phil. The other one is that, look, people, they don't do it because people always buy high, sell high and buy higher, right? But the smart money is looking for where we have value. And where there's value right now is in what we would call the commodities of not necessarily precious metal commodities, but the industrial type. We have a couple that are basically twofers, right? We have silver, we have platinum, we have palladium. They're considered what I would call both precious and industrial. And the other one too is we have food inflation is coming back from a commodity level too, because of what's happening geopolitically, and also the grand solar minimum, and now is starting to really whip the low and high pressure systems. The jet streams really getting wavy, and that's going to cause more and more issues with commodity production. And so for us, we're looking at owning silver miners. We talked about that this weekend. We should do another one on food inflation. There's some really good stocks to own in that area. And then, believe it or not, energy is far from dead. And now there's a mass scramble because production is collapsing worldwide. There's going to be a mass scramble towards re-energizing these wells that they made dormant, Phil, because prices started to fall. And we're going to see probably oil prices between $90 and $100 here before the year is out in all likelihood.
Wow. Yeah, that'd be a good bump. That kind of ties into if we were to go into the recessionary environment, then and you typically kind of do see commodities hold up as you enter that, and as markets start to digest that and roll over, typically things like metals and like oil and other commodities do pretty well in that cycle for, just for whatever reason. That's just always been the flows, and so that timing for that would be interesting to say the least, because you and I are looking at probabilities of recession just based on the data we've been presenting over the last few weeks, that it looks pretty strong here.
Yeah, and look, at some of the stuff, no matter how recessionary you are, if you need it, you need it. And so, you're looking at, there's not enough energy being produced and there's not enough food being produced. So we're going to get the worst possible world. We're going to get a recession, Phil. At the same time, we're going to have a mismatch between supply and demand for energy and food, and that sets up stagflation. And then how the government's going to react to that. They're going to panic and they're going to throw money at the system, but instead of it going to AI stocks, all that money is going to be poured into the commodity sector, because people are going to rotate into that because they're going to be horrified at the CPI numbers.
Yeah, I would agree with you. That would probably be a shock to the system, and that would affect the price of the S&P 500. And that's something that we might want to segue into now. And you had brought up this chart, Bob, about how many days it was since we had last seen a 1% decline, and that's this chart here. So you guys can see we're on 37 days. I think it's now 38 as of this video, and you can see where we don't typically, when we get to 37, you're getting toward the upper end of the most common distance. So you see 37s, 35s, 41s, 32s. There's a lot of those, so we're within a week of what we would call like the mean expectation of at least a 1% pullback, maybe even more. Unless we go full tilt, then you're probably not seeing one for another month going on for, then you jump up to like 66 or, 75 days. And if you get super extreme, you're going to be 90 to 100 plus days, but keep in mind those 90 to 100 plus days, we're in an environment where the Fed was often accommodating, and so we did the price action was very one way, and that's not really the environment we're in. And and they're actively tightening with the QT and things like that. So we're probably, in terms of which one are we going to get, I'd say we're probably within a week, Bob. And that kind of ties in with OPEX. OPEX would actually agree with these numbers too, because if we can show you guys the OPEX chart, OPEX is options expiration. And one thing that you guys need to understand is that as you go into the third Friday of every month, you will get the monthly options expiration. And that's a lot of stocks and things like that. And the stock indices are tied to that. And you're going to get usually a move into it and a move out of it. So, I was talking to Bob before we recorded, and we were talking about like some OPEX, you'll see a follow through the next week to the downside and sometimes to the upside. And really what it boils down to as of late is whether or not we have positive gamma going into an expiration or negative gamma. And that's really has to do with the options hedging. So, is the options hedging such that we're in a positive gamma environment? And if we're in a positive gamma environment, the dealers typically have to trade against price. Okay. That means that as price goes up, they're actually making the order books a little thicker because they're trading against price. If it's negative gamma, they're trading with price, and then price gets more whippy. So that's the difference. So basically you have a little bit more docile price action or a sustained price action. And that's what we've been seeing lately. You have the sustained trend. But when we go into a negative gamma environment, it's a lot more volatile. It's a lot more whippy. And so when you have the either or, if it's positive, you're typically going to see a sell-off after options expiration. If it's positive gamma, then you're typically going to see a sell-off. So negative gamma, you're going to see some follow through. Positive gamma, you're going to see a sell off. So we have a very, very positive gamma expiration coming up here. Very positive. And so as we've seen with the other chart where we haven't seen a 1% pullback in 37, 38 days, we also have this very positive gamma options expiration that happens this Friday. So it's implying that we have a very good probability of seeing red next week. And as you guys can see on the chart too, there's a lot of gaps below us, and the market tends to clean those up. So we could see at least a pullback. It could be as much as below 4,400 And of course, with the strong move that we've had and this AI hysteria, we're probably going to see some dip buying after the pullback. But for the month, this is one of those setups where you have a pretty good probability that we may have seen the high there on Wednesday. And the reason why we say that too is because going into OPEX, a lot of times you'll see a high on Tuesday or Wednesday. So you have all of these things that are kind of coming together here to give us decent odds. And on top of that, the flows kind of suggest with dollar and yields in the bond market that those things might be supportive of lower equities into the month end going into the first week of August. So there's a lot of things kind of converging here that make today's high up near 46.10 potentially the high for the month. And then they may try to go back up in there after a pullback and try to grab one more run higher there to try to grab that later. That's my read, Bob. I don't know if you agree, but that's what this data is telling me.
Yeah, and I mean, for people that don't know positive and gamma exposure, it's you get to a point where there is so many option contracts that basically the dealers are full. And so once you get across that, and positive and gamma, you're talking about when it crosses over the call wall, correct, Phil?
Yeah, typically in that environment, and really what it is there's a point in the hedging, right, where it starts to become overwhelmingly weighted to the call side versus the put side. And so typically when you're in that situation, then the gamma is positive.
Yeah, basically think about a boat lean, right? The boat's leaning now in such an environment where people ate too much. They're going to have to basically puke it up. And that's when you see these sell-offs. And so, this is a thing, by the way, guys, if you want to write things down and learn something here is you get a lot of positive gamma option expirations. So typically the fourth week of the month is negative, as a general rule. And so those are the setups that, you like to look for. And here, Phil has, took the time here to express what this looks like over time. And now that we're tied in with this 37 days of no 1%, you know why 1% is important, Phil? Is that what they've been doing, and the reason why the market has been relentless is that they immediately every day on these 0 days to expiration is that you got institutions selling puts 1% below the current price. And that's a lot of premium to do that, right? And that's expressed as a positive. It's called positive 0 DTE premium. When you buy a call and sell a put, it's the same thing. It's a positive number for options. And then they turn around and they sell calls, Phil, with the money that they receive from selling the puts. And they basically turbocharge to move higher. And so if you get a negative 1% day, you basically upset that apple cart. You're forcing the speculators to cover their bets. And when they do that, the market makers are then allowed to sell the market off. And so now we have a twofer. We have way too many calls going into options expiration. And we have a thing where basically the bags are full on the 0 DTE game, and there's likely a reversal coming. So that's why we kind of make the claim that, hey, we probably had a top today because interesting, we struggled. We made an early high, and then we sold down and we couldn't recover it, which is normal. And now, we're looking for, between now and at least next Friday, the market should be much lower. And also we have the Fed meeting Tuesday and Wednesday next week, which really complicates things.
Yeah, and we have there's large gamma support down below 4,400. So you could run into a situation where, let's just say things do get dicey to the downside. And I don't think that really becomes a factor until we start getting under 4,500 on the SPX. But if we are to do that, then things do get a little dicey because the problem here is that there's so little downside protection that all of a sudden people are going to start scrambling for that. And you're going to go from a positive gamma environment to a negative gamma environment very quickly. And that's where things get really volatile. And then where the 0 DTE guys get messed up is when we start gapping down hard, because if you gap down enough, you're just not going to be able to get that morning push because things are so negative the next day. Like Bob was saying, you start creating the other effect where it becomes a snowball the other way. Right now we have a snowball going uphill, but you can reverse that when things, and the setup here is good for that because of the lack of downside protection. If there was a lot of downside protection like there was in June, that's not so much the case. In fact, you can almost say that the downside risks are pretty minimal. But here, there is very little put protection right now, and that's very obvious in the data. So there is a risk here for a decent slide down. Now, is that the top of the top? That remains to be seen. But I certainly think that when they do get down below 4,400, we're probably going to find our footing somewhere down there if we do that move. And I think there will be a decent bounce back up. And who knows, they may even try to attack the highs again. So tops take a while, but typically if you do get a potential top in, when we do start to come back up, you're going to watch for that to be a lower high. Otherwise, if they go back and attack that high, then they could very well bust this higher. The other thing we have to keep an eye on is the reverse repos and whether or not those are starting to go back up, because that without a doubt has been fueling this market, and they've been using that utility, which, by the way, and Bob and I have been talking about this, we'll probably do a video on it. RRP, reverse repo, that window didn't always used to be there. That's something the Fed created to bail the banks out, and the last time they took that away, we crashed. So, and at the end of the day, we'll talk about the dynamics more, but it's not good. And it's actually inflationary because there's a lot of interest payments that's being infused into the system and into the banks that's ultimately going back out into the system now. And so that's for another discussion, but that's what's fueling the move right now. So we'll keep tabs on that as well as we head lower.
And the only thing I want to say is that today we're just sitting watching the price action. And I don't know, Phil, I went through like 30 or 40 stocks of names that you would recognize. Mm-hmm. And all I kept seeing today was Doji, Gravestone Doji, inverted hammer, dark cloud cover, bearish engulfing patterns. We left and right, and across the board, it was a very broad mix. In fact, I closed most of my speculative longs today. Mm-hmm. I didn't see a carry going forward. The only thing I kept is my core, precious metals and my core energy names, and I have those well covered with solds and dividends. So I went to hunker down. I rolled out all my puts that I have for hedges into August. I rolled out SVXY puts, I rolled out SPY puts, I rolled out Q puts, and so I'm sitting here waiting. And if we do get that 10-day correction, Phil, then it would be a good place to cover going into the end of the month.
Yeah, and likewise in crypto too, I'm going through the charts and there's just like nothing I can really say go out there and bid on for, like in the altcoin market. Most of those are what we're seeing. The action is very much just day trading stuff. There's nothing really I can say that looks good going out, a couple of weeks. I think we're entering a window of weakness, which you also get with OPEX, right? You typically will get that window of weakness if you are in that positive gamma environment, which we are. And even Bitcoin too is losing this humongous range that we've been in for about 25 days, Bob. And if we start cracking under 29K, that's probably kissing that range goodbye, which is actually really bearish, because then it turns that whole 30K and above level into resistance, and we're probably going to see lower than 29 and maybe dip our toes into the 27s, and that's the risk now over the next couple of weeks, or maybe next 2 to 3 weeks. I think is a significant pullback in Bitcoin, and then we'll see how much stamina the bulls have buying that dip and seeing if they can push us back up. But that's going to turn 30K into pretty stout resistance. So over the next few weeks with crypto, it like stocks, it's not looking real pretty.
Yeah, just so you guys know, there's no organic buying in the market. So whatever you hear or read or Twitter bulls tell you, there's no organic buying. 2/3 of 0 DTE are institutions, and they're closing shop every single day. The rest of the people are retail, trying to grab the brass ring every day. The people are going to be left holding the bag are basically mutual funds, pension funds, these large managed accounts that have been passive. They're going to all get hit really, really hard because a lot of the speculators now have left the stocks, equities, and they're playing everything. They're doing what's called replacement theory. They're doing everything through call options now that, if they get blown up, they don't care. They got most of their risk out. And so it's going to be the 401k families that are going to get their heads handed to them, and anybody else who thinks that we're in a bull market.
Yeah, I totally agree. I think the market's going into a new era of how it operates and how it operates on leverage, and I think we're seeing another round that we saw going from, that's how come GameStop and all those things got blew up, was because of this whole using calls and options as leverage now, especially now with the advent of 0 DTE. So I think we have a new era here, and it's not going to change, so we have to be very cognizant of what's fueling. Is it liquidity positive or is it liquidity negative? And because it's going to be, I think, very volatile. I don't think we're going back to docile days and docile summers anymore. I think we're going to have an environment where we're constantly levered up and it's going to be volatile, but that works both ways. So anyway, we'll try to stay on top of it. The markets are evolving, and so are our views, but we still think that the underlying fundamentals of a recession are still very much real, and you got to be cognizant of that stuff. So anyway, that's all I had, Bob. Guys, thanks for watching. Please hit like and subscribe, and thanks for all of your views. And if you can smash that notification bell, set it to all, that really helps out our channel as well. Bob, thank you. We'll see you guys on the next video. Take care.
Trade Genius.